Folks, we are going to pivot with the speed of light. We're going to talk about today's GDP report. What was it? 4.9%, almost 5%. We have Liz Peek, syndicated columnist and Fox News contributor. We have Jason Trennert, chairman and CEO of Strategic Securities. And we have Brian Brenberg, co-host of The Big Money Show, right here on Fox Business. Okay, my lickety-split, fast, top-line number, big number.
Big number.
Under the hood, lots of problems for the future numbers. Liz Peek, I will let you start.
Yeah, big number. But by the way, with the $2 trillion deficit running, it should be a big number. What's under the hood is continued pretty high level of inflation, lower real disposable income for, I think, the third month in a row, which does not augur well for consumer spending. And that's really kind of what we're looking for going forward. And by the way, finally, a big increase in government spending, as we've seen the last couple of months. And that is something that is really pushing this economy forward.
A third of the increase, by the way, for this number was from inventory accumulation, about a third of it. That's not sustainable. But Jason, you know, your guy, Dan Clifton, had been writing, because of the debt ceiling debate, where they had to postpone the final debt ceiling authorization, you know, for an increase. The Treasury ran down the Treasury cash balances. I don't know, I won't get too much into that, but it's kind of like the Federal Reserve. The Treasury can create money in the short run. They basically injected $500 or $600 billion into the economy. $500 or $600 billion into the economy late last spring, which I think went right into consumer spending in the third quarter.
Absolutely. So you actually,
so it's a phony. It's almost like a hoax.
You had a double-barreled dose of stimulus after Silicon Valley Bank failed. The Fed's balance sheet increased by $400 billion in about 3 weeks after Silicon Valley Bank failed, and then because you weren't issuing new treasuries, you drew down all of the cash reserves of the Treasury Department, which is another $600 billion. And so it's not surprising, in a way, that you have strong growth. I would say, though, avoiding a recession at all costs, which seems to be what Janet Yellen and everyone else in the administration wants to do, has a cost. And that cost is inflation. And that's why I'm of the view that this is going to be harder. It's going to be harder to put the genie back in the bottle than perhaps the Fed and others in the markets think, that inflation will be more structural moving forward because we are running deficits of 5.5% of GDP.
PCE deflator, the core deflator, it's up 3.9%. You're still running 3 or 4% inflation. Brian Brenberg, President Biden, Treasury Secretary Yellen says our problems are solved.
Yeah, they're not supply-siders. That's the problem. They look at this number and they say, oh, my goodness, 4.9% because it's built on all of this deficit and debt spending. It's not income driven. Real incomes are not rising. People are dipping into their savings. And that's what they can feel. They know, like they can say at a high level, oh, the economy grew. But at an individual level, people say, I know what I'm paying for things and I know where I got the money. And I don't like where I'm going for the money right now. This summer was a blowout spending summer, but it was a services spending summer, Larry. And that is buy now,
Taylor Swift.
Pay later, or maybe pay never.
I think 3 percentage points go to the Taylor Swift concert.
You would know, Larry.
Seriously.
You're the fan here.
I'm the only one in the building that hasn't been to the Taylor Swift concert, and I don't intend to go. Now she's hooked up with a football player from one of the teams that I dislike the most, so I sure as hell aren't going to go. Liz Peek, I want to come back to the inflation. You know, if you take out enough categories of inflation, you can get low inflation, right? That's what Paul Krugman did. He took out. So I talked to a great pal of mine. I'm not going to name his name because I'm responsible for the editorial part of this, but I said, okay, I want you to take out everything but food and energy. Leave food and energy in, take out everything else in the inflation index. So in the third quarter, that was up 6.6% at an annual rate. My logic is very simple here. Food and energy is what people buy. Gasoline, groceries, okay? 6.6% at an annual rate. People should do this exercise. Take out every other bloody thing. Beat them at their own game.
Well, I think that's right. And frankly, if you added in housing, it would also be in that kind of category.
I'm not going to touch housing.
I know. But those are the things. Those are the things that people feel, and that's what they're reacting to. Yes. It has an impact on consumer sentiment, has an impact on spending, I think, going forward. I mean, you know, some of the best economists on Wall Street are saying we're at a turning point, and you can see it in the employment data. in the auto delinquencies on consumer debt, that we really are getting to the end of this big consumer bubble that you were just talking about.
Yep.
Consumers can't go on spending forever. The savings rate came down to 3.8, I think, in this last quarter.
Right.
Way lower than it was earlier in the year. It can't go on forever.
I would say this. You still have an inverted yield curve. It's been inverted now for a while. That suggests the New York Fed model, 60% chance of recession next year. You still have 18 straight months of declining index of leading indicators.
Now it's down big.
I wouldn't diss that. Now, Jason's stocks battled itself today, but wound up down again. The NASDAQ is in a very, very mean correction, and the mortgage rate is running over 8%.
Well, I think the best leading indicator, as we've talked about, is profits. And profits are lower this year than they were last year. What's surprising is that the employment picture has held up well. I think that explains, to a certain extent, why consumer spending has been better. But there's only so long companies are going to hoard workers or hoard labor after a period of finding it difficult to find them before they start to say, gee, we have to take care of our own profits. And to me, that's the best leading indicator of all. It's the mother's milk of economic growth, as you said.
Mother's milk of stocks, the lifeblood of the economy. And Brian, I'm going to give you the last word because Jason's on to this. Business investment fell again. Business investment's been down 2 of the last 3 quarters. Now, the Bidens like that because they hate business. All right? So why not crush it? But Brian Brenberg, I always thought it was business success that created the wherewithal for jobs and the economy and consumer spending.
The problem is we've got the cart before the horse big time right now. And the horse is saying, I don't want to pull anymore. I'm pulling back. I'm out. I don't like this environment. So you can go on clapping about 4.9%, but you better enjoy it now because as the consumer runs out of steam, the businesses have already said, I'm out until I get a policy that actually works for us, and it's not happening under Biden right now.
Absolutely right. I'll go back to my model. Take everything out of the price index. Just leave in food and energy, up 6.6% an annual rate. Fed's got a problem. Liz Peek, Jason Trennert, and Brian Brenberg. Folks, be sure to catch Brian, Big Money Show, weekdays at 1 p.m. Eastern, right here on Fox Business. It's my fave.